welcome everybody. This is I guess the second or the third virtual real estate leadership speaker series. The title of the series today is How is 2021 different from 2020? And the world we live in, there's a lot of things that happened in 2020 that I don't need to tell you much about, but definitely 2021 is going to be different. So our speakers today are going to tell you how. For those that don't know me, I'm Dr. Eli Bracha. I'm the director of the Holo School of Real Estate, also a professor in the real estate program. And my job today is actually very minimal. Usually I take place in either speaking in those panels or moderating them. Today we're taking a different approach. Basically, I invited 4 real estate experts, Mr. Malcolm Butters, Mr. Jose Juncadella, Mr. Rafi Zitvar, and Mr. Marc Shuster to basically have a conversation. Marc Shuster will be the one that is going to be leading the conversation. Each one of them will have an opportunity to introduce himself in just a little bit, but they each have expertise in different areas, which will make this conversation even more special. All the speakers today are also members of our real estate advisory board, which means that they're not just contributing money to help our students at FIU, but also contributing their time, mentoring our students, and do a lot of great things for our school. So we're really, really thankful for time and efforts to make the whole School of Real Estate as good as it can be. Before I hand it to Marc Shuster, I just want to make sure that all our participants, they're aware of our master's program in real estate. We have a 1-year program available online and in person. We are ranked number 1 in the world in terms of real estate productivity, and we're very, very proud of that. All our faculty hold real estate, a PhD in real estate, and also have practical real estate experience. If you want more information about this master in real estate, Mr. Federico Berger will put his email on the chat, and you can contact him to get some more information. So with that said, I'm going to step back. I'm going to hand it to you, Marc, and I'm really looking forward to what all of you has to say today. Thank you so much.
Thank you, Dr. Braga, very much. And welcome everyone to a really special FIU community event. It's really exciting to be here. I want to especially thank Carlos Mayo for putting this together, and the larger FIU community for supporting what is really, I hope, a fruitful panel, and one which you'll learn from and fire away on questions. Marc Shuster here, I'll be the moderator. I run the family office practice for the law firm of Berger, Singerman, where I'm a partner. And we cover around 190 families, most of whom are offshore, that is out of the country, and who are investors here in the US. If you start from the premise of the last 12, 13 years, where yields have been the major thing people have focused on, my specific background, I come from a family, a hotel family, is really more in real estate. So I have a specialty in alternatives. Most of the families that I cover, I either act as the outside consigliere for, because of my business background, vetting deals, evaluating deals, again, in alternatives, real estate, oil and gas, not in equities markets, not in replacement for a Goldman Sachs broker that somebody has or money manager, but rather families who want exposure, and then all the way up to billion-dollar families where they have full-throated family offices and where I'm simply playing straight lawyer and doing deals around the country for them when I'm asked. It's a really interesting practice because I probably see every kind of deal. There aren't a lot of deals that have come across my desk that surprise me. And so if and to the extent anyone has any interesting questions directed to me in this realm, I'm happy to have them. I guess next I'm going to move to Jose and ask Jose to introduce himself. Jose has a really rich background, and without further ado.
Well, thank you so much, Marc. It's great to be here. My name is Jose Juncadella. I'm actually a graduate of the FIU real estate program, which I'm very proud. I have been a commercial real estate broker for 38 years. I am a member of SIOR with dual specialty designation in office and industrial real estate, which is what I've done through all those years. My firm, Fairchild Partners, works mostly with institutional investors, and we handle several million square feet of office and industrial real estate. I'm very happy to be a part of this leadership series with other market experts. Thank you.
Hey, Rafi, please.
Hey guys, my name is Rafi Zitvar. I'm a partner at Global Fund Investments. We invest in primarily in grocery anchored shopping centers in the Southeast and most recently in Arizona as well. We currently own about 4 million square feet of retail space. We started in 2007, I want to say, and we bought a lot during the heydays of 2009 and 2011 and 12 and so forth. We started selling around 15, and as I said, our current portfolio consists of about 40 shopping centers, 4 million square feet.
Okay, and last but not least, Mr. Butters.
Thank you. Malcolm Butters, and I'm president of Butters Construction Development. And like Jose, I'm also a proud graduate of the FIU Master's Program. I graduated in '83. Butters Construction Development, we're a 6-time NAIOP Developer of the Year down here in South Florida. We specialize mostly in industrial and office. And we currently have several large projects underway in Miami. One of them we recently closed on was a $53 million land purchase with Greystar on 45 acres. And we're also co-developing a project with First Industrial called First Miami. So very thankful to be here with you guys, and we look forward to the conversation.
Great. Well, we all know what the predicate is, which is 21 versus 20. And maybe said differently, what happened in 20? It's really kind of interesting because many of us who also lived through 2008 have some comparison there. And we'll get to that as a roadmap a little bit down the road. But sort of we thought the first thing to talk about would be really some of the winners and losers of 2020 in real estate along asset classes. So I guess first up, the question that we had is industrials, multifamily. We've all seen they've had good runs in the pandemic. Are those good times going to continue in 21 and beyond? Do we see that as sort of a bellwether for the green shoot part of the 20 economy in 21? Let me go to Malcolm.
Thank you. Well, I think for sure those are the two real estate sectors that have done the best, over the past year. I think for sure they've continued. Like I referenced that deal that we just completed. It's in Miami, which we're really excited about. Everyone knows South Florida has limited land, and the land is currently zoned for garden-style apartments, and we're converting some of it to industrial. So our viewpoint was, and we put our money where our mouth is with our partners, is we think it is going to continue because, either going to do garden style apartment and or industrial. I think, if you look at industrial, the fundamentals are there, right? The growth in e-commerce at the expense of, brick and mortar retail. So that's expected to continue. And I think, the trend towards multifamily and I just, with the population growth down here in South Florida, I just don't see how it stops anytime soon. There might be some bumps in the road, a little bit of overbuilding here or there, but I could tell you that the 40 years that I've lived in South Florida, I haven't seen yet where, over a 10-year period, the real estate's been worth less in either of those categories. To me, industrial and multifamily, I just think it's a sure bet.
So a quick little data point before I turn it to Jose. I have a lot of families interested, and it's reported every day in the journal about the industrial boom and foreign money flocking to industrial. So what Malcolm says to me rings true. Jose, are we all wet, or are you with us?
No, I am totally with you. I think at least in South Florida, in Florida in general, industrial and office leasing in particular, definitely having a good run so far this year. And we expect it to continue through 21, 22, with what they call 1,000 people moving to Florida each day, and major companies announcing plans to relocate or expanding the Sunshine State weekly. Miami has become a top destination for finance and technology. We continue seeing articles in the Wall Street Journal, Bloomberg, CNBC, and the Miami Herald, while Mayor Suarez in social media convincing new businesses to come to Miami. So it is positive. It really is. We're in a great location, and we should benefit. So we are a winner in office and industrial.
So it's interesting because in respect to initially March, April in 20, we saw some multifamily owners really give a cap rate full point COVID discount. That has gone away. I mean, what we've now have seen is particularly in the Sun Belt and the Smile States of the US, there seems to still be a seller's market, very, very hard to find good deals in primary or secondary cities. And it really feels what you're telling me, that's going to continue. And we don't see any pain, real pain, systemic pain. And maybe buttressing that is this idea that there still isn't enough affordable housing, particularly in South Florida. And we'll talk about that later. Okay, we're up to good old Rafi. Rafi, I'm going to switch it on you. You're the bad news bear. 2020 was not kind to retail, restaurants, hotels. Talk to us.
So I think that, well, it depends what type of retail. Obviously, hotels and restaurants were hit pretty badly. But I think that hotels and restaurants are going to be back. I mean, it sounds to me, so I'm not sure if I'm the bearer of bad news in this respect, but I feel like we are at the tail end of the pandemic. And, just, in November, we were notified that vaccinations are going to be available. And now, in some countries where I'm coming from, originally from Israel, almost half of the population has been vaccinated. I think that over the past few months, we're going to see a lot of that. And I think that life is going to return to normal in terms of hotels and restaurants specifically, and then retail. I mean, if I may share my screen, we can look at, hold on, a CBRE leading indicator report from last month. So it's not, it's not as current as I would want it to be. But we can see that, if restaurant diners, if it went down to basically a complete stop in March of last year, we're basically now up and we're almost back, half of the way. As it relates to travels, we are, back, call it 40% of the way. And hotel demand, I guess we are back like 2/4 of the way or 2/3 of the way. And in terms of the occupancy, and the rates are, the average daily rate is back 80% of the way. And that's without, with the vaccines not being as widely spread out as we want it to be. And so to your question, I think that hotels and restaurants are going to be back. As it relates to retail, over the past, call it decade, we've seen a shift from traditional retail to experience-based retail, in the sense that, and let me just see how I stop the sharing. There we go. I think that so basically the move was from traditional clothing stores to gyms and trampoline parks and so forth. And COVID hit all these experience-based retail badly. At the same time, I can tell you that in my asset class, which is primarily grocery anchored, our rent collection is north of 95%. It's true that we lost some occupancy, but it was marginal. And so I think that, some retail categories are dead, and the closed malls, the power centers that have big box tenants that, currently they don't need all that space. And that's unrelated to the pandemic. It's just a trend that was, invigorated by the pandemic. But some asset classes like grocery anchored, service-based retail, I think is going to continue to show strength.
Okay, so we hear from Rafi that the WFH, work from home, and the asset classes that touch that have done well. That's why we see industrial and industrial directly connected to the grocery anchored shopping centers you're talking about. We also learn that we believe restaurants and hotels are coming back. I mean, probably airlines need to get to about 1 million passengers a day across the US to have appropriate lift. Ed Bastian from Delta thinks that's soon. A lot of people share Rafi's sentiment that we're rounding the corner and the pent up demand is there. So that's interesting. And I guess the place I would turn next, Jose, tell me about office.
Well, like Rafi mentioned, there's still concerns, continued concern of the pandemic through this year, but the rollout of the vaccine has created a greater sense of optimism in the market. Although supply has increased through vacancy and new deliveries in 2020 in our market, pent-up demand for new to market tenants will likely offset some of those headwinds in 2021. We're seeing that firms are reevaluating future space needs, considering health protocols, and successful large-scale work from home experiment, because we've never seen anything like this before. But in general, we don't call it downsizing, we call it right sizing with regards to tenant in the market. To gain clarity on these fronts, even many financial stable office occupiers are either delaying space decisions or opting for short-term renewal leases. That's what we're seeing overall in our office portfolios that we handle. What type of demand we're seeing in our office portfolio? We're seeing a lot of medical, mental health, plastic surgery, because people can wait, government agencies, tech companies. In the suburbia market space, projects in Doral, Kendall, Coral Gables, and the Grove, we have seen new appreciation of projects such as one we handle, which is downtown Doral, which is over 1 million square feet with live, work, play, and learn environments. Companies are looking for that type of environment, smaller building, open spaces. The jury's still not back into what the future office is going to look like. We know that we're seeing the possibility of less denser offices. When it used to be 1 for 250 per square foot, one person per 250, now we're seeing 1 per 300. So even though there's a discussion or reduction of offices, because we need to be more spread, there hasn't been too much of a reduction overall. But we do see that there's more requirements for air filtration, natural light, and so forth. Where we're seeing a tremendous amount of activity is in the brick-old market. Some colleagues tell me that there's close to 1 million square feet of market activity right now. One of the new buildings that is in the market is the 664,000 square feet, 830 brickle, which some rents are beyond comprehension in our market, $75, $80 per square foot. But again, we're seeing companies like Blackstone, Icon, Enterprise, and Starwood Capital coming into our market, which is obviously very positive.
I've heard this, there's a crude analogy of somewhat if the Brazilians came in after 2008 and bought a lot of the condos, are the New York private equity hedge funds coming in to pay the $75 a foot on Brickell? It's almost
they probably see it cheaper in Miami than anywhere else. We're alarmed by those kind of rental rates, but probably as compared to New York and other markets, it's not as expensive.
Malcolm, what's the Broward situation here?
Well, the Broward, and I'm just going to follow up on one thing that Rafi said. I do think very much that the retail is coming back, and I'll give you just a personal experience. I went with my wife this weekend to Atlantic Avenue in Delray, which is the main retail restaurant drag. And if I tell you, Marc, it was packed like it was New Year's Eve on a Saturday. I've never seen it any busier. And I think when I speak to my son who lives on Brickell, he told me a couple of weeks ago, Miami, he was at Miami Beach, and because you wouldn't believe how much activity. So definitely, I have 100% confidence the restaurant market's going to come back, and a lot of the hotel will come back too. I mean, certainly the good stuff on the beach is going to get revived. Office in Broward, I think it's steady. There's definitely been a slowdown. There's no doubt about it. We have a couple office buildings in Broward, a couple in Palm Beach, in Boca Raton. We own one in Atlanta and Buckhead, but I think it's definitely slowed down. There was a little bit of a pop maybe in spring, but unlike Miami, we're not getting the same amount of influx. I think with the Blackstones and the Goldman Sachses that has made headlines. There's a big debate as to how much impact is that going to have. Obviously, it has some, but when you talk about somebody like Blackstone taking 40,000 square feet in Miami, they were replacing, I think, a Regis. Jose might correct me, but I think it was just a substitution. So like the net effect was a zero. It does sound good and it's better than nothing, but so I think it's yet to come. I think the office in terms of getting a spec office off the ground, I think it would be almost impossible. I think the 830 Brickell is an exception. I think it's a very wealthy foreign gentleman, and I think that's probably the best building in the market, so they're getting a lot of attention. But in general, for the rest of us, I think it's going to be it's a long sleigh ride home. And I think, they're definitely holding their own in terms of occupancy. We saw a slight maybe loss on some of our tenants, but for the most, I'm talking maybe a 5% drop in some occupancies in some of our buildings, some are a little higher. But in general, I think the market's definitely a little slower. I think there was definitely more velocity, a year ago than there was now.
Okay. All right. So now that we've sort of discussed most of the major asset classes, I kind of opened it to the floor. Give me a sort of a big time 2021 bold prediction of a specific, maybe within an asset class. Rafi, you have something?
Yeah, I think that it might be anecdotal and small, but I think that the ghost kitchens are going to be a green shoot. You see it. I mean, people basically order in a bunch of food, and you don't need restaurants, prime location restaurants to do that, and you can see a bunch of including the Travis Kalanick big, nationwide project, but you have a bunch of entrepreneurs setting up kitchens that can house a bunch of restaurants, and basically the entire existence of these restaurants is virtual, and I think that that's going to serve a need.
Yeah, to buttress what Rafi was saying, the Uber co-founder was very early on ghost kitchens. I think even before the pandemic. I don't even think I knew what it was when I first read the headline.
Yep.
It was not connected to the pandemic. I think. Jose?
Yeah, I mean, I can say a few things about industrial, and Malcolm can attest to them. But we're seeing, for so many years in industrial, we've seen the same type of buildings. A new generation of buildings that were 32 foot clear. The column spacing was 54 by 50. That type of building, mostly rear loading. We're starting to see more cold storage in terms of buildings that are being developed. We see Prudential PGIM in our market developed strictly cold storage space. We're seeing that technology is getting to the buildings where we're seeing now it's easier to develop 40-foot clear heights. We're seeing that some buildings are requiring more power, more trailer parking. Some will have roof insulation to allow more air condition, and some that could structurally allow for solar panels. So we're seeing more e-commerce being developed in our markets. We state as the brokers that every single project out there has an Amazon component to them. So we're seeing tremendous growth on that. Probably Malcolm can see the same.
Yeah, I mean, I agree with everything Jose said. I mean, look, industrial, I don't think anything you're going to do in industrial for the most part should work, especially here because there's not as much competition, and the land is harder to come by. But if you wanted like an outlier that I think would do, and I know is doing really well, that not too many are building, is if you tend to go towards smaller bay, get a 4 to 10,000 square foot area. That one I've heard tremendous success stories. We're a general contractor for one of them, and they're getting like $14 triple net rents for industrial. So to me, that's if you wanted like an outlier green shoot, smaller bay industrial, I think, and Jose will attest to it. The most things that we're doing with institutional guys is usually the 20,000 square foot bay and up. But if you go a little smaller, I think there's a tremendous opportunity there. And again, cold storage, of course, yes. I mean, Jose is 100% right. We're insulating the roofs now on most of our buildings because we do find most of the tenants now are going towards air conditioning their warehouse. And if you put it in now versus having to put in some sort of stick pin insulation or spray on insulation on the underside of the roof, it's gonna be cleaner, less expensive, and it's easier to capture a tenant. I think energy codes are only getting more strict, especially with climate change. So I think you're way ahead if you do that now. But the warehouses today are definitely, they're not just a plain old dirty box. They're very, very intricate. A lot of fiber optics and IT, and it's becoming a whole different world with e-commerce.
I agree.
So maybe to that point, 4 states in November legalized marijuana to be recreational. And so many people are looking at their warehouses in the right areas and thinking there's a bid up war for cannabis space, distribution, growth, maybe even retail. But if you think about where cannabis lives, usually it's in these kinds of same places that we see industrial.
Yeah.
So we maybe expect that could continue. And so clients that have properties in those 4 states, New Jersey, Arizona, I forget the other 2, have started to see bidding
Colorado.
wars.
California.
Yeah, full, and they're fully recreational. So you might expect to see pops there too.
Yeah.
Okay, so kind of leading to that question, the next question, guys, is geography. And we've talked about asset classes. We've talked about maybe special green shoots in asset classes. Where do we do deals in 21? Rafi.
So let's talk about losers. So I think that we'll start with the losers. I think that New York City, San Francisco, Chicago, Boston are clear losers of the pandemic. I think that for now at least, I think that the super dense urban lifestyle was just very susceptible to COVID. And I think that with people working from home and with the new generation of millennials and so forth that would like to a more balanced work-life ratio, I feel like the Sunbelt states for sure. I mean, the Smile states for sure, big winners. So be it Florida, Georgia, Texas, Arizona, as well as the mountain states, Colorado, Utah, just places where these millennials and many others and retirees just would like to enjoy the inviting weather and the more affordable lifestyle than that available in along the coastlines.
Jose?
Yeah, I mean, we definitely see South Florida as benefiting. There's no question there. Our geography, it helps. I mean, we're seeing so many. You go through the street, you see so many cars with plates from all over California, New York, and so forth. So definitely, we're a winner. And in South Florida, except for our land, we're so land constrained that it's kind of difficult to continue to develop in a large scale. but it definitely favors our weather and our climate. Our taxes favor South Florida.
So if South Florida won the pandemic, what does that mean for investors? I mean, Malcolm, is it too expensive to be in South Florida?
Well, I guess, it's a two-edged sword, right? It's harder to buy every day, but it's a lot easier to sell. So so you can make money. Look, we have an industrial project, and we asked recently for a broker opinion of value to one of the nationals, and they came back and they appraised a very nice new fully leased industrial complex here in South Florida and Broward at a 3.8 cap at $225 to $240 a foot. So, on the other hand, land has gone, Marc, from being, $40 a buildable foot to, in some cases, not us necessarily, but, the market now is probably $60 to $70 a buildable foot over a 4-year period. And there's guys, and Jose will tell you this, that have bought recently for $2 million an acre, which translates to probably $100 a buildable foot. So it's very difficult to buy things. You got to buy them right. But the market's great. I think we're a benefit. Like I said, on the sell side, Florida's a winner all the way. And states like North Carolina, Central Florida, Orlando. On the industrial side, I like the port cities. Savannah is doing exceptionally well, and also Charleston. So probably our next move would probably be and we have actually 2 projects now in Central Florida, and we're looking at more stuff in possibly in those port areas too.
That's a very interesting data point. I do a tremendous amount of deal work in Texas and in North Carolina, Georgia for sure, Northern Florida. It's hard to see the numbers work on an acquisition here in Miami. There's a lot, I'd say, of trophy acquisition here. So to your point of the 830 Brickell, there's a lot of just exceptional wealth that does deals in those types of cities. But back to what Rafi's saying, it's hard to see for at least a couple of years the New Yorks and the LAs really benefiting. It seems like we've got a big head start from our treatment during the pandemic and the steps that we've taken. And I fully agree.
Yeah, and Marc, I say, to me, it's, a lot of people come here and people talk about the weather, and the pandemic, but I think the underlying factor at the end is, I think that tax, that extra sales tax, income tax in Florida, it's an extra, 10% or something. And people are like, I'm done. The pandemic pushed them over the edge. But I think when you dig down deep in California too, I think it's just the taxes, or people are saying, look, it's not deductible anymore, at least currently. So I'm paying extra 10%. And, there's guys that obviously are making good money. And if you're making even, $500,000 a year, that's $50,000 less a year you'd save on schooling or housing or whatever. And you get the better lifestyle and the nice weather. So I just, that trend started many, many years ago. I mean, ever since we came down here, you've had New Yorkers coming down to South Florida, but it's accelerated rapidly. I've never seen this pace. We've always relied on South America to bail us out on, on growth and all that. And now it's definitely the Northeast, and the floodgates are open.
I mean, I can tell you it's not even anecdotal at this point. I have several New York and Montreal and Los Angeles families that have bought pied-à-terres that are, 4th or 5th home here in Miami in the last 6 or 8 months. And it's because, and I'll quote them, they can walk around. It's open. The world is open here. I mean, there's
New York. I mean, New York is a new Venezuela for us, right? I mean, they just keep buying stuff and coming here. To me, I've never seen it this active, and it's good. I mean, to me, it's great for South Florida.
So I think at this juncture, we're going to move into a discussion a little bit on macro topics and how the Fed and how monetary policy influences real estate. So for all of you on the webinar, it's time to stretch, get yourself a coffee, do your thing. We're going to transition. I don't know if we're set up for questions or if I see there is a Q&A button. Maybe Ellie, is there, we'll reserve that at the end. That might make more sense. So hold your questions for asset classes. We're going to move now to the discussion on the Fed. So the Fed, looks like probably, maybe even it's already happened, but there's going to be a pretty sizable additional relief package of 1.9 trillion. Anyone want to take a dive into kind of how this shapes or how it impacts real estate here in Florida?
I can try.
Please.
So for sure, let's talk about the difference between 2008 and now. So 2008 was a market failure that led to a total collapse of the system. Here, it's a true black swan that is completely exogenic to the market. And we did not see the credit, the lack of credit, and on the contrary. And so the government stepped in. Governments all over the world stepped in immediately. And I think, and I don't know if I'm taking away the next question or addressing the next question, but I think that there's a lot of debate whether the relief is necessary or not. And the way I see it, initially the relief, there is no doubt in my mind that the relief was necessary, because I view the situation in April and May of last year with all these stay-at-home orders as an equivalent of condemnation by the government. So basically the government is telling you, hey, you cannot, business owner, you cannot operate your business now, and because of whatever reason, right or wrong, and now we need to compensate you, or we need to compensate the societies to keep it going. So in my mind, it was at least in the initial stages, it was very much justified, and I think that it helped a lot. And the question now, and you mentioned, the new package of the 1.9 trillion is how much and what is the extent, and how do you spread the wealth? And just as a as a benchmark, I think that the program in 2008, we were talking about government support to the tune of $750 billion, and now we're talking about 5, 6, whatever trillion dollars, and like every day we're throwing out trillions as if it's nothing. The one thing that does help the Fed and the government is the fact that rates are really low. So if we are to finance the government support with historic low 30-year rates or whatnot, we're talking about negligible. And I think, I've been following Professor Linneman from the Wharton School, and he did some calculation and analysis as to what is going to be the effect. But really, the debt service for all the trillions of dollars that are being printed now, if you finance them over 30 years at current rate, is not overly material with respect to the budget of the federal government. So maybe it's sustainable. In my opinion, the extent of the relief is way too great. It leads to I think that the biggest discrepancy I've ever witnessed in my short life between asset pricing and Wall Street, stock pricing and the life of in Main Street. I live in Texas. Last week there was no water and power in my house, and people act as if nothing happened. Markets continue to go up simply because there is so much money that was pumped into the system that, in my mind, at some point is going to lead to inflation, is going to lead to increase in rates, and maybe ultimately will lead to cap rate expansion. namely increase in cap rate, reduction in real estate valuations.
It seems like if you think about the most important rate you can talk about, the 10-year, which is creeping up. I mean, I don't know if anyone's paying attention to inflation, but there is arguably, when Bitcoin's trading at 50,000 a coin, inflation in that. I mean, if maybe it's not in consumer prices, but it seems to be in asset classes.
Absolutely. So the price of bread is the price of bread. It hasn't changed. But if you look at home prices in Colorado or in Miami or in Florida or all over, I mean, you see the crazy increases year over year. And so, yeah, you have, I mean, it's just not, it's not reflected in the official inflation metrics, but it's there, it's here.
Jose, are we headed to Armageddon?
Well, not really. I think for the next few years, there's going to be a lot of money in the economy. I think it's definitely is going to help. But in the long run, I agree with Rafi. I think this is we're going to be eventually in an economy with a lot of inflation and a lot of issues with regards to the amount of interest rates going up and so forth. So in the short term, I think it's going to be positive to our economy. In the long term, I think it's going to be a detriment.
Okay. Malcolm?
Look, I think there's no doubt the deficit is a major problem. I think, the politicians tend to gloss over it. We're at what, 24 trillion or whatever we're at now. And, if you look at the US dollar, it's gone from, earlier in the year, not this year, but I mean, in 2020, we were at even with the Swiss franc, and now, the Swiss franc is like $1.12. So, we've lost 12%, and I just use that because, the Swiss have not been printing money like, some of the other Western economies. But I think it's just an issue. I don't know what the answer is really, Marc. And there's definitely some relief because, fortunately for most of the people on this panel, it hasn't been as big a problem of the pandemic. But there are people out there you got to be sensitive to that have lost their jobs. They worked at restaurants, hotels, etc., Disney World. It's a classic example. They say, the difference between a recession and a depression is, if your neighbor gets laid off, it's a recession, and if you get laid off, it's a depression. So, for people that are in food lines, they need the relief. But I think, unfortunately, the government doesn't have the guts to just cut back in other sectors, whether it's, Social Security or something. But it's needed. They're going to have to do some balancing somewhere because it's definitely going to come to roost, right? You just can't keep going like this.
And sort of to roll back to what Rafi raised, and I thank him for raising the comparison from 08. So is 21 compared to 20 still the game of chasing yields? Meaning, I mean, if you're an investor, is the reason why Bitcoin in the stock market and real estate in the Sun Belt maintains just a function of these low rates? And does that mean, are these low rates here forever? In which case, are we in a new normal where governments continue to buy up huge swaths of bonds and we never see real 4% growth? Maybe in this year, because we have a Mardi Gras release of the pandemic, but just generally. And Rafi, what do you think of that?
So I think the first part of the question is yes. I think that 2021 is going to be continue to be a chase for yield simply because rates are as low as you mentioned. But I think that it's not sustainable. I think that at some point rates are going to go up because inflation is going to go up. I don't think that the MO by which people sit at home, watch Netflix, get tons of money from the government, being checks and PPP money and this and that, is sustainable because the definition, the layman definition of inflation is that you have more money chasing the same amount of goods and services. So as we keep on printing money and spreading it out to people, it should lead to inflation. Inflation leads to increase in rates. Increase in rates create better investment alternatives, be it in the fixed income side or others, and that leads to cap rate expansion. That lead to I think at some point some price adjustment, downward adjustment to real estate pricing.
Jose?
Yeah, I mean, I agree with Rafi. I think I believe the same thing. I do think that in the short term, we're going to see low interest rates. But yeah, there's pressure for interest rates to go up, and obviously there's going to be inflation. In our markets, they're going to act differently. I think the yields are going to be slower to creep up. I think it's a different type of economy what we have in South Florida. I think that with the population grows, there continues being demand for residential, for industrial, for office, and we're such a land-constrained market that the pressure on rents is always going to be up because Malcolm would attest, finding property now to develop that is not an old golf course, a landfill, a lake field, a golf, it's very difficult. So it will be a little bit different in South Florida, but definitely interest rates in the next couple of years are going to start, in my opinion, going up, and the yields will start increasing.
Malcolm, anything to add?
Yeah, I mean, said it all. I mean, I think short-term rates are definitely going to stay low because they're going to keep them low, but they'll probably get closer. I mean, I don't think we go where when I started our career and when I graduated from FIU in '83, interest rates literally on my first job at a school was working with Travelers Insurance doing loans, and rates were at 14%. So I don't think we're going to get there. But yeah, can you see that the 10-year Treasury going from 1.3 something today to 1.75 at the end of the year? Yeah, for sure. So it'll creep back up. I think we're probably artificially low for at least the next year or so.
If you look at the German Bund, it's had the greatest 10-year bop, it's up 12% in the last, couple of weeks. It really does feel like inflation is around the corner. And that, I think, to Rafi's point, is the biggest threat to rising interest rates. Now, having said that, there's a strong belief among people I deal with every day that just generally think interest rates in the short term are going to be low for investing. And so that's why you continue to see deals get financed and done. Okay, great. What lessons can we learn from this pandemic, which are similar to, different from 2008, or new, nothing to do with 2008? Rafi?
My lesson, I have actually a few takeaways from 2008. First and foremost, as always in real estate, low leverage is key for sustainability. So if you have low leverage, you can go through periods of global disruption like the ones we're experiencing now and fare well. That's one. Two, in 2008, and after 2008, there was a bunch of real estate opportunities, and basically anyone that bought in 2009 and 10 and 11 has done very well. So I think, we were very, very cautious buying in those years because it was just a very frightening period. I feel like in my sector, we are seeing a lot of opportunities, retail opportunities in grocery anchored and so forth, that are a result of the pandemic and COVID and the lack of bank financing or the lack of financing for retail properties. And my personal takeaway from 2008 is, hey, when a deal makes sense, do it and move on. You cannot time the market. You need, it seems to me that it's a good acquisition environment in my asset class. Buy. If you can buy cheap enough and take advantage of the fact that that you're a cash buyer and that you can move fast and you can that the pricing can the deal pricing is reflected by that.
Malcolm?
Yeah, I agree with Rafi. I think low leverage is key no matter what. I think, the environment for real estate has changed so dramatically over the years. And like I said before, from when I started, developers were leveraging, 80, 90, even 100% back in the 80s. So today, most deals are, 50 to 65% leverage on tops. So that is definitely key. I think diversification is a good strategy too, whether it's geographic. If you had all your assets in one category, in this case, if it was all in hotels or potentially retail, you might be feeling it a little harder than if you had a couple different categories in the different cities. So I would have a diversification strategy so that, it's good to be in Florida, but if you wanted to hedge and you go to visit Rafi in Texas, that's not a bad maneuver too. And I think always take on partners, right? Don't go all in on yourself. It's good to spread out. When you have operators like Jose or myself or Rafi, take on partners. There's usually some fee income that comes along with it. So you make a return on your investment, and at the same time, you're generating some cash flow, recurring cash flow. So I think that's a good lesson too.
Jose?
Yeah, I don't think I can add much more, but of what has been said by Rafi and Malcolm. Leverage is the biggest difference from 2008 to now. 2008 is financial crisis. Now we're seeing more of a pandemic crisis, but we're recuperating pretty fast. I think there's opportunity in every market. There were much more opportunities in 2008, 2009, when cash was king. You could buy a lot of properties, and like Rafi said, you could do well even in the years to come because prices just went through the roof. It is a little bit different now. It's very difficult to buy properties. There's opportunities in older markets, let's say industrial and office, to repurpose properties, but because interest rates are so low, the financing so low that the price of the properties, the price per pound, is very high. So it's very difficult to find opportunities right now that in the long term will make sense unless there's a good amount of inflation involved.
Well, I do think that you can see opportunities in retail, you can see opportunities in hotels, you can see opportunities in office, you can see opportunities in all these asset classes that we all identified as the losers of this current environment. And I feel like, again, the ability to buy cash and the lack of financing or the very low leverage offered or recourse based financing that is offered. I think that actually make these opportunities more emphasized, and this is what I mean when I refer to buying. I think that or to executing on these opportunities. I'm not a multifamily person. It might be a very good asset class that has benefited tremendously from the situation, but we are trying to generate well above market returns, and I would focus on these asset classes in terms of capitalizing on this very unique period in time.
And so, and in conjunction with what Rafi said, and Malcolm, I think that anyone seeing this webinar should spend real time with Dr. B on the sort of financial underpinnings of these transactions, because they're not getting less sophisticated. And so most of the time, where I spend most of my time in the day is structuring joint venture agreements where money, LP, meets Mr. Butters, and there's a deal among the joint venture that is probably, I don't know, 20 or 30 years old. It wasn't done in the 1950s. It just wasn't. So now most real estate projects actually look like a full-throated real estate private equity fund. You've got a GP, maybe it's a Delaware LLC, and you've got a Delaware LP. You may have a blocker entity for foreign investors that are coming in, maybe through the BVI or the Isle of Man or Scotland or wherever they're coming in. You're talking about a promote, or more technically a carried interest. You're talking about sometimes a double promote, where one of the families acts as themselves a balance sheet syndicator and raises money among the people they're bringing to the dance and sitting on the economic side of the GP. So these are the kinds of things that as a student of real estate, you'll see more of, I think, not less of, as people syndicate investments. And that's something that I would say I've seen each year more and more, not less and less, and a trend line even from 2008 where you see more of it. And it speaks to what Malcolm was talking about of delevering his risk profile by taking on additional partners.
Yeah.
Anybody have?
There's more, Marc, and just to add on that, you could tell if you looked at, the structure of most deals and the value of real estate today and who the ownership was now versus, again, from the 80s or 90s when rates were higher, it's 100% more institutional ownership. And that's why, even though we all try to find deals, and there's always going to be deals, to Rafi's point, but we've been looking, it's harder to find these opportunistic deals over the last couple of recessions because there's so much more institutional money, so much less leverage. So there will be deals, but the flood of deals like they had in the early 90s with the RTC crisis, you're not going to see.
I agree.
I agree. We're like Malcolm says, this is a market of institutions. When 20 years ago there were so many private developers in South Florida, it's very difficult to find the local developer, except Malcolm, that covers the area of Miami-Dade, Broward, and Palm Beach. But most of the industrial markets and office are really controlled by institutions. So that has been a change from the early 80s for sure.
But I will say, I mean, I agree that there is a lot of institutional capital, but really maybe the opportunities lie where the institutions don't want to be right now. So institutions want to be now in industrial multifamily. Great, let's let them play. Let's focus on industries. I mean, if you have a good operating track record of hotels, yeah, let's buy hotels and maybe convert them, maybe work with them, maybe redevelop them, maybe just wait. And I think that you'll be able to generate above market returns.
Yeah, especially like hotels. Like we're involved in 2 hotels as limited partners, more or less. But the hotel industry, like if you go to New York, I would think, Rafi, you're going to have a lot of opportunities, right? A lot of more defaults. Down here in Miami Beach, I don't think you're going to have a lot of hotels defaulting. Some might be hurting more than others, but in general, I think in the extended stay hotels are going to do fine. So I think you got to pick and choose the geography, because I think the states that are not, the deals will be in states that are having decreasing population growth, like New York, right? New York City potentially, but the states where, like Texas, where Rafi's at, or where Florida, where Jose and I are, I think there's less opportunistic deals. Like we chase office deals here, and if you look, recently, the related guys bought Phillips Point, which is one of the better office buildings in Palm Beach, but still a very old office building, and they paid over $400 a square foot. There's smart money, but no bargain there, right? And there's stuff, and we chased an office deal recently that's in the market in Palm Beach Gardens, and that's going to trade for close to $300 a square foot. So I don't think people have given up on office as an asset class. And if it's in a good area like Austin, Texas, I think you're going to still have to pay, probably in the 6s or maybe 7 to get that asset on a cap rate basis. So they're not giving it away for sure.
No, and to your point about hotels, hotels along highways are doing quite well. Hotels and vacation spots are doing quite well. Hotels connected to airports that rely on passenger travel, not so much. But
Or
unlike
convention hotels are suffering.
and convention, yeah, for sure. But unlike 2008, I mean, I'm doing. Lenders are loath to go through the full arsenal of what I saw in 2008. And as a general rule, you're right. We've been able to be successful in getting extensions and modifications and interest rate downs and changes in amortization, all things to relieve the pressure of the monthly payment so that you can cash flow.
Yeah.
Okay. We sort of get into a question here now that's always dogged most real estate panels here in South Florida, and it's really the affordability question, and it's an issue for Rafi as well. How does the country, how do you guys think about affordability and what the government should pay attention to ensure that the teachers and waiters, waitresses, the people that are the engine of the economy have places to live in places like South Florida or in the Dallas metro?
Well, I guess affordability is a big problem. I think that we are seeing the divide of between the haves and have-not has been expanding, and we can see that the people with the means have been by and large benefiting from this situation, and you can see people that from less affluent backgrounds that are really suffering. So I think that the phenomenon of lack of affordable housing can be found in any major city in the world right now, be it in any European capital, in any major city in the US. And the fact that we're seeing mentions in South Florida selling for $5 and $10 and $15 million, it's all great. By the way, I can say that unlike 2008, at least the pricing here is driven by people that are actually moving to South Florida to live in, and not as a speculation. So that has a sustainable aspect to it. But I don't think that it helps the waiter or the waitress that is making $10 or $12 or $15 an hour to pay his or her bills. So that's a problem, and I don't know. I can tell you, I go to Colorado to Steamboat a lot, and just because I like the area, and I can tell you that the city there has been initiating a bunch of public-private initiatives, housing initiatives, by which the city provides tax credits for developers to develop affordable housing for the support community, because many wealthy people go to Colorado, but there have to be a class of teachers and waiters and lift operators that need to live in these places and need to be able to pay the bills.
Well said, Jose.
Well, it's difficult to find a solution. I mean, just from the perspective of South Florida, it is so expensive to live here. It's so hard to find land to develop. The other day I read in the paper, the average housing is now $450,000. The only way I think is going to be some way of the private and public sector to joint venture in order to develop, because I don't see how a private developer can build this type of housing and be profitable. So it's going to be challenging for years to come, no question about it. And prices keep rising, and it's not going to help.
And Malcolm.
Yeah, I mean, what could you say? It's definitely a problem. Look, I was in the camp. I think the raising the minimum wage is a good start. I believe that getting it to $15 an hour is a good thing, and helping those people in that category get them a little boost. So, but it's a difficult situation, and somehow it seems to work out. It always has. It's not been a new situation. that we've been talking about that forever here. In South Florida, I think what we have to do is we're fortunate. We have the great population growth. I think we've got to maintain a really high level of education, our public schools, because I think that's going to help us, sustain that growth, and it's going to also help, the population, increase their income. I just think it's going to help a little bit of a groundswell, hopefully, for an affordability issue if people get better education, and that's why I like Dr. Ellie and the people at FIU. I think they do a terrific job, because by providing tremendous education at affordable houses, it hopefully lifts them up, increases their standing, and lets them buy those expensive homes that Jose said. So I think it's just I think it's great to get more housing and cheaper housing, but I think there's a lot of things we have to do as a country, and certainly as a state, to help them get out of there. And I think education and institutions like FIU is a great start to help them.
Okay. So a couple questions I sort of surveyed, previewed from the group in the webinar. I'll ask you guys, because I think they're good questions that fold in. One question was the online or resources, the rags you use to stay current. Avid reader of the Wall Street Journal and the FT, the Financial Times. I'm a macro guy, so I'm interested in how markets move, how the real estate relates to the stock market, and what inflation means and how it impacts interest rates. So that's the world I'm interested in, and I think you should always consider reading those kinds of daily digests for the world and what's going on. And many times the Wall Street Journal covers real estate stories specific. They'll talk about the pop happening in Austin or wherever. And it's so it's not like they're going to leave you out. You could always read local stuff, the real deal, if that strikes your fancy. But I do think you have to have an understanding of the economy. Rafi, what do you read, or what online tools do you use?
I don't know. I read a lot. I will say that by reading market trends and research reports, I always try to apply critical reading, because in periods like the ones that we're seeing now, because we're living in a world of extremes now. Everything changes so fast. It seems like the conventional wisdom changes very fast. And so you can read you can see it. All of us are real estate professionals. You can see it with a bunch of appraisals, and see how an appraisal for a property changes over time. One year it's valued more than anything, and another year it's worthless, just because and you have thick appraisal reports that justify both contradicting conclusions. So read a lot. What do I read? I read the Wall Street Journal. I read a bunch of real estate research provided by the major brokerage firms. I follow a bunch of universities. Specifically, I'm a Wharton grad, so I'm a member of the real estate the real estate club there, and there is a lot of research that is coming from there. And but I try to be critical and try to find the niche where there is opportunity that is counter or against the conventional wisdom of everyone.
Okay, Jose.
I read so many emails come through with so many reports. In addition to the Wall Street Journal that I read almost daily, and Bloomberg and so forth. I read a lot of real estate information that comes from the different brokers' houses, from national groups, in order to maintain ourselves informed of what's happening, not only in our market, but everywhere else, because it's kind of a world economy. Everything has an impact on everything else. So, like Rafi, a lot of those publications I read.
Okay. Malcolm?
Yeah, no, Wall Street Journal, I think, is a must for everybody every day. Barron's, always kind of fun to read about at the end of the week. But yeah, like like Jose said, there's just so much. I think there's more information now, Mark, that's available than any time before. Every morning Globe Street puts out something online, the CBREs and the JLLs, and every day there's a new market report. So to be honest with you, I actually read probably less, unfortunately, because I read it because it's online, or I read it, you know, but I don't think you have to seek publications because there's so much now that's for free almost, other than maybe the Wall Street Journal and stuff. But there's a lot of information, and and there's good shows on television too. Fareed Zakaria on CNN gives you a good global perspective on politics. So there's tons of information, more than ever. So I think you just got to stay in tune. And, if you're in real estate, like all those publications that we talked about, you just get them online and just keep going through them. But it's hard to keep up, to be honest with you, with all the reading that comes across our desk every day.
Okay. I think maybe we've entered into the bold prediction component of the webinar. This is really exciting. This is where I get to ask my panel members about something that they will predict will occur. And it's not cold storage is the next. It's more sort of personal, or more, it's different. And I'll go first to kind of give an example of what we're talking about. COVID has been a nightmare for everybody, and deadly. I also, though, think that the untold story of COVID is the emotional component. And I think that there's going to be stories that we're starting to hear, but beyond just the public health and the medical, the depression, the abusers who's abused, who stay with abusers, discord in relationships, divorce breakups, office problems, getting workers back in the groove when they come back to the office. COVID has created so much more than just a public health crisis. It's really created a social crisis on how we relate to each other. And as sad as that is, I think that we all maybe could think about the people in our lives that we see every day and interact with, and how we treat them, and maybe, double down on trying to be the person we want to be, because this is a really tough time for everybody. So that's kind of my thing I see that people don't talk enough about. Sorry to be so positive. Jose.
Well, I mean, things are changing so fast. I usually tell my two sons that are in the business that in the business world, the business has changed and evolved 5-6 times to where it's totally different than the way we used to do business 10 years ago. I think it's no secret that remote work will continue to be prevalent. We need to reimagine the future workplace as a network of ecosystems, of spaces that are adaptable, cost-effective. It's just that we have changed. There's a new way of working that I think is going to change the way we do things in the future. So but one thing I do know, that we in general want to go back to the office. I think the social aspect of being with people, with other people, is always there. There's going to be more of what they call a hub and spoke model. People working from home certain days of the week, and some from in the office. But the social part of it is very critical. And I think I see it in my own office. All the brokers starting to come in, they do enjoy that camaraderie and that discussion among peers. So that's again, there is going to be a little bit more remote work, but still a lot of the social part will remain the same.
That's really I agree with that. And basically, the death of the office has been greatly exaggerated. That's kind of what you're saying. Okay, Rafi.
I think that again, we're at the tail end of COVID. I agree with you that it's been devastating. I think that I have more international perspective because I grew up in Israel, so I always look at I compare Israel to the U.S. Israel, on the one hand, as I mentioned, vaccinated a great share of the population, yet they had like 3 or 4 lockdowns, and I think that in the U.S. the approach of that was taken after the initial the first 2 months of COVID, the approach was, hey, let's try to adapt. Let's not kill the economy, because the social aspects and personal aspects that you mentioned are just prices that people pay. I mean, people died alone without their families. People, I can see it with my oldest daughter. She could, she had to have she had to cancel her bat mitzvah, which is something that is typically shared among family. And but to the point, I think that we as a family benefited from COVID as well. Just knowing that we had the ability to spend time together and enjoy each other's company and develop other hobbies that are not necessarily that we didn't have before. And I do think that faster than what everyone thinks, we're going to go back to normal. We're going to go back. There's going to be a huge pent-up demand in recreational tourism, simply because people are just ready. And I have just gotten back from Colorado a few days ago. The Houston airport was packed. So, and flying a few months ago, it was a ghost town. So I think that as the vaccines are going to be more prevalent, and as people are more comfortable wearing masks but getting out of the houses, life is going to return to normality. And at some point, COVID in 2020 and maybe the beginning of 2021 are just going to be viewed as a period that everyone remembers. But I don't know if it's going to be that transformational to our lifestyle, for decades to come.
Yeah, no, you said a lot of things, and I agree with all of them. You see much more lift in airports these days than early on. Countries dealing with it in a much different ways that have produced, I don't even know if it's produced such different results. I mean, it's just an interest. It's sort of like this exogenous thing has impacted us, and we're all dealing with it. And it's really, it's almost like a Rorschach test when you hear people ask people, hey, he cut the line to get vaccinated, as if there's a morality component now to being in a war
Right.
of trying to save. It's so interesting, right? Sociologists are going to study this period for a really long time.
Yeah, but remember, I mean, just a few months ago, just getting a COVID test was very difficult. Now you want to get a test, you can get a
That's
test in
true.
2 seconds. So
Yeah.
vaccines are going to be, now they're rare, but in a month, you want to get vaccinated, you'll get vaccinated. And once that happens, our life is gonna return to normality.
Malcolm, you're bringing the rear up.
Yeah, so look, I think a lot of it that said is true. But I think a lot of these things from the pandemic are going to stay with us. And I think, things like wearing a mask, where it was unheard of here. And, my wife and I, we went to Japan 2 years ago, and we were on one of those bullet trains, and you'd be sitting there, and people in the waiting room be wearing masks, and we thought that was odd. Now you could say, hey, look, I'm going to go to the airport. I might wear a mask too, in the United States going forward, even if there is a vaccine. Look, this conference, the whole Zoom, whatever you want, the virtual stuff, I don't think that's going away anytime soon, right? That wasn't normal 2 years ago. Normal, I would go and I'd meet with Ellie, I'd meet with, Jose or Rafi. Well, Rafi's, I'd have to get on a plane, but, Marc, we could go meet. But it's so much more convenient. Why go from my office in Broward, go through traffic? It's convenient to just dial up, 3 or 4 people in Dade County. These things are not going to go away. So working from home, I agree. Office is not going away, But I do see that people in our office, they like working 3 days or 4 days in the office and 1 day from home. These are going to stay with us. So there's going to be definitely some return to some normalcy, but it's not, I don't, it's going to be, some of these things are going to stick with us for sure, longer term.
Yeah, I think both could be true. I mean, I think there are people who will stay home and Zoom from their pajamas for the rest of their life. I happen to be in my office here on Brickell today, and most every day is when I'm not on a plane. And I have been traveling throughout the pandemic. It's part of kind of my job and what I have to do. But for others who can do what they do at home, I think you're right. They won't. Why would they? Or they'll do what you're saying, 2 or 3 days a week in the office. And what that probably means is that tenants are going to request smaller floor plates. The interesting thing, it's in hotels, we don't see a lot of the rate move, but occupancy moves. And that kind of gets to your point. So does a tenant take 15,000 feet instead of 25,000 feet? But are they going to pay the same per foot that they would have? And it's interesting. Well,
Yeah.
Dr. B, I think we're done here. And I'd just like to extend a big thank you to the panel, to FIU, to Carlos, Ellie, Rafi, Malcolm, Jose. Really wonderful. And I personally enjoyed it very much. I hope people got a good thing out of it.
Any Q&A that we should do, or we should leave the question unanswered?
I can't. So I keep getting to my Q&A and keep losing the screen. And some of them we've talked about. Some of them are a little bit too specific, I think, for this panel. I can ask, how much of the perception of office that we have is based on government assistance? I think we've sort of answered that, but so and then there's very sort of questions I would say are not really on point.
I guess let's go over. I mean, I see there's a question about investments in Reits.
Yeah, I'm not.
We have a few more minutes. So Rafi, you like to talk about Reits? Go ahead.
Yeah, take a swing at Reits.
I talk to my students all the time about Reits and tell them about the hidden gems. So
Ellie, talk to them about Reits.
Exactly.
Well, I guess I'm not fully sitting back today. I'll say a few words about Reits. I guess that is part of my expertise. I was telling my students that, in the beginning of the pandemic, when, the stay-home order started and people started panic, everybody went to the supermarket and got toilet paper. And at the same time, rate prices, even though in many cases occupancy stayed the same and valuation in many cases actually went up on the private market, those prices went down, 40, 50, and in some cases, if you're retail, you talk about 80% discount for something that is a period, like Rafi said, something that is going to pass. The world is going to change a little bit, but overall, the period itself is going to pass. And at the same time, I told them, instead of buying toilet paper, I was buying Reits. There's a lot of things that we're trading in a big discount between what they trade in the private market versus what they trade in the public market. So, for example, apartments is a great example. Even if some of them are holding properties in states or cities where people are maybe leaving, at least temporarily, the cap rate differential was maybe 2-3% almost between what you get them in the public market. You could get them for 5.5%, 6.5%. And then if you want to buy the same quality assets in the private market, you would pay 3.5%, 4%. It does not make any sense. So a lot of that closed already, but there's still a lot of opportunities there. I see still in the apartment sector, a lot of Reits trading at 20% discount to net asset value. And in the retail and office, the differences are even larger. In the retail, if you know how to buy right, there are probably a lot of them that are still trading 35% below NAV. So there's still opportunities there if you know where to look.
Okay.
Rafi, you wanted to talk about that, so go ahead, please.
I was just reading one of the questions, but I'm not going to recommend anyone to invest. Get to the market right now, because I feel like by and large market pricing is in my mind a little high. But I do agree with you that there is always a divide between Wall Street and Main Street in terms of real estate pricing. And yeah, I mean, if you look at equity residential, for instance, as it's one of as an example of an office REIT, or sorry, as a residential REIT that has a bunch of assets in New York City, but many other communities, you can see a big discount to the public vehicle, to the REITs, versus the the pricing of buying these properties outright in the open market. And so if you are to invest in REITs, or if if you are to invest in real estate, and the question is, should I buy an individual asset or should I buy a REIT? I would look for these discrepancies where the public markets are underpricing or when you have discounts to as you mentioned, to the NAV, and at least you're getting with the REIT, you're getting the liquidity, you're getting the diversification, you're getting a by and large experienced management team, and you're getting the transparency and whatever the market, the public markets offer. So if the alternative is buying, if you're not a real estate professional, if the alternative is buying private or public, I would always choose buying public.
Certainly makes sense. Liquidity, experienced operator, the black hole of private real estate. Yeah, sure. Okay. There were a lot of questions about sort of specific one-offs or discussions on what conversions look like. Have you guys seen a lot of conversions, just in terms of hotels becoming apartment buildings, or what? Any kind of interesting conversions you want to talk about, or opportunities?
In New York City, you have hotels that high-end hotels that basically the city has been renting and for housing of homeless people. So
Right.
I don't know if it's not a long-term conversion, but it's a temporary use conversion. Are we going to see offices being converted to residential? Maybe. Are we going to see? I mean, I think that that's the evolution of that is happening constantly.
I
Okay.
think we maybe have time for one more, and then we'll to conclude.
Okay. Building prices. There's a couple questions on that. And you touched on it, Malcolm.
Yeah.
Copper market's going nuts. It's just much more expensive to build right now.
Yeah, steel prices have gone up, somewhere in the neighborhood of 25 to 30% over the last 6 months. So, and there's delays. I think one of the things, Marc, that we've seen is, when the prior administration started to tinker with tariffs, a lot of manufacturers started moving operations from China to, other places, Vietnam and, Thailand or wherever. And then the pandemic hit, and the transition has not been, really that smooth. So there's actually shortages in some respects for many basic building commodities like lights, air conditioning equipment parts. And, we don't manufacture them necessarily over here. So it's causing some inflation too. So I think, lumber has gone up. So that we're definitely seeing an increase in pricing because the economy is doing well, but also we've seen some increasing in pricing because the supply chain has been disrupted with the pandemic and some of these tariffs.
Dr. B?
All right. I guess I'm the one concluding and saying, first of all, thank you for the distinguished panel. I learned a lot. I really enjoyed that. I love Marc. You led a really a great discussion, and Rafi, Malcolm, and Jose, you answer it like champs. I really enjoyed that. I learned a lot myself.
Let's do it again.
Yeah, we'll do, that's what I was about to say. Let's do it again. Hopefully, we will be able to do that in person. I'm promising everybody that we'll definitely make up for COVID. The first time we are going to get together, whether it is board meetings or advisory meeting, or whether it is panels like that, we'll make it very special. So it will be well worth the wait. So again, thank you everybody. Thank you everybody for attending, and we'll see you in the next seminar.
Thank you.
Thank you.
Bye-bye.
Thank you.